Hi, I'm Perry Atkinson, General Manager here at theDove. Hey, check out our other videos and check out our website at thedove.us. Hi, welcome back. And my guest, Dan Kosmatka. He is a CPA, Certified Public Accountant with his own company, Kosmatka and Donnelly Company. And we're here to talk about that three-letter word, tax.
That and death, right?
Yeah, they're that and taxes and death. They're pretty consistent, aren't they? Anyway, here we are. April 15th coming at us pretty fast. This is when you CPAs are working long hours.
We are.
Are you?
Yes, we are.
Boy.
6 days a week.
6 days a week. Well, that's good.
Got to take that day of rest.
That's right. Well, yeah, do that, and you can get caught up in golf in May sometime.
Right.
Hey, Dan, has this tax thing gotten more confusing?
Yes, it has. I was envisioning this morning, what's a good thing to say about it? Well, we have a huge puzzle. That's how I see the tax code. Tax code is a tremendous puzzle that has moving pieces. They're not even always in the same place. So we're constantly working with those pieces to find how they fit together. And that's probably a simple visual of how to think of the code.
Well, I've tried to look at it. That's why we hire guys like you. I can't. You do your thing, I'll do my thing. Is it safe for those who don't have a complicated return to go online and do it?
It's reasonably safe, I would say. What I worry about for someone filing online is that with identity theft anymore, you're putting your social security number, your name, your address, and maybe even your birth date online. And you want to make sure that the provider you're using has some kind of safety net to protect that information.
Wow. Is there a common mistake that those people make without going for professional help? Would they oversee something that would be to their advantage or not see something?
Oftentimes what we might see in that situation is someone might have a better benefit if they're itemizing their deductions versus using standard deduction. I think that's probably the one of the things I would say is the value of looking at what you have, maybe talking with a professional on it, and seeing if you have enough itemized deductions to benefit versus using standard deduction.
Is there an income line that draws that?
As a single person, $6,100 is the standard deduction, and as a married couple, $12,200. And then there's the exemption amount of $3,900.
Okay. Homeowners, is there a common mistake they make when filing?
Well, probably again back to forgetting to itemize. They have the mortgage interest, they have the property taxes that they can take as a deduction, and if they're not looking at those dollar amounts along with their charitable contributions and other deductible amounts, they may be missing an opportunity to have a better reduction of their taxable income than if they use the standard deduction.
So for a homeowner, it would be the interest and the taxes.
Property taxes.
Okay.
And then in addition to that, though, if you look at the Schedule A, they have medical, although medical is a potential problem right now too, because they've increased the threshold that you have to incur before you get a real deduction. You have to be greater than 10% of your adjusted gross income in your medical expenses before there's any real value to that deduction. Caveat, if you're 65 or older, then you still have the 7% threshold.
All right, so keep all your receipts.
Right.
Okay, what about retirees? What should they be looking for in the way of benefits or things that they should have when they get ready to file?
Well, when I think of retirees, the thing I think of is, one, is as you transition from a working life to a retired life, you need to think about those taxes because you've traditionally probably had your taxes withheld out of your wages, your W-2 earnings.
Right.
And as you go into retirement, you may or may not have withholdings out of your pension, and if not, you need to be looking at whether you need to be making estimated tax payments, which are due quarterly. Right. That'll keep you out of penalty. So that's the thing you need to look at in that initial year of transitioning from work to retirement. And then the other thought that pops in my mind typically when I'm talking with somebody in that situation is plan your retirement so that you can live within your budget.
Yeah, absolutely. Get
Yes.
a planner, talk to a guy like him.
Yeah.
Those who own businesses, sometimes they own them personally, sometimes they're in an LLC, sometimes they're in a corporation. Any concerns there when they're filing? Probably a ton.
Lots of options. There are unique aspects to each of those ownership styles, so that's where the professional can help you and guide you on what is the best format. Things that we're seeing that can be complicating for and maybe not even complicating, but changing for people who are in business, is that we've had what's called Code Section 179, which is essentially an accelerated depreciation. You buy an asset and you want to depreciate that asset as quickly as possible to recover that cost and put those additional dollars back to work. Up through the end of 2013, we've had a $500,000 level of Code Section 179 deductions that could be claimed by a business, and that has now been reduced for 2014 to $25,000. So there's a much slower recovery period for that investment when someone makes an investment in that equipment.
On depreciation schedules, is there lines? I mean, is there a minimum? And is there a minimum depreciation life or a maximum depreciation life?
There are lives that are based on the type of asset that you're putting to work. And in some assets, automobiles as an example, they limit how much of an annual deduction you can take. And that was because of luxury autos. For a while, people were taking advantage of that. And there's ways to plan with that, but that's one of the things that we have to deal with, is unique lives for different assets.
All right, the 15th is coming up pretty fast. And who should file an extension? And what are you doing to yourself if you do this?
I've heard different stories of whether you should or shouldn't extend. If you have your tax information ready and you've got it done, go ahead and get it done. File, process it. If you're still waiting for K-1s, that's what I often find, is people are still waiting for tax information, because back to these LLCs, S-Corps, some of those entities have not gotten those returns ready, and the individual needs the K-1 from that investment to be able to file their return. So that's often one of the main reasons, other than just procrastination, that we see people needing to extend their return.
All right, so what do you see coming down the road here? Is it getting easier, more complicated? I think the last year when we had you in, you were concerned about some things in the future that were unclear. Where are we now? The tax code, how crazy is it?
Still a challenge, and a subject that I really don't want to go into, but is the healthcare mandates.
Yeah.
You think of how that's complicating people's lives and business lives, and what we have to deal with there, as far as if you're not under this new program, when it finally gets effective, because it keeps getting delayed, there's going to be penalties for those people who are not properly participating in the program.
There's great concern that some of these deductions of the past may be taken away. Some politicians see them as loopholes. Do you see any changes like that?
One of the ones I heard of recently that gives me a little heartburn is the elimination of the personal residence exclusion. Currently, you can have a couple can have a $500,000 gain in a house and not have to pay any tax on it. They're talking about taking that away, or at least I heard one senator making some comments to that effect, that might be an area that they can tax the wealthy again by reducing the benefit of the one-time, or not even a one-time, it's every couple of years. If you have a $500,000 gain or less, you don't pay any tax on that personal residence. As a single person, it's $250, but generally I'm dealing with couples.
So if you, again, if you live in a house for more than 2 years as your permanent residence, you sell it, you have tax-free up to $500,000. I thought the capital gains was not touched by then. What am I missing here?
The exclusion is a $500,000 for a couple.
For a couple.
Yes, and you can, every 2 years, you can sell a house, and if you have a continual gain occurring, you can defer or actually eliminate that taxable gain. You do not have to pay tax on that gain. And it's only beyond that you would have an income tax liability.
People are selling their homes at losses now. I mean,
Right.
And how does that work in their favor? Or does it?
A loss on a personal residence is not deductible. So that's just an economic loss with no tax benefit.
Wow. Okay. 1031s, what are they? People, you hear them battered around. I know what they are, but tell our viewers.
1031 exchanges are a vehicle where people are able to take one investment. Let's say they own an office building, and they can exchange that property or that asset into another piece of property. It could be a building, could be a farm, it could be some other investment that's considered like kind, and you take that gain essentially and roll it to the new property, which means you lower the basis, the purchase price, by the amount of gain that you didn't pay tax on. So that gain is deferred until you actually sell that second piece of property.
Okay. Second homes. Is there any benefits to them? And the other question that comes out of that, are some of these RVs considered second homes?
Yes.
Really?
Yes. So as long as it has a bathroom and a shower, you can treat that motor home or trailer or whatever as a second residence. So a first and second residence, you get to deduct the interest if you have a loan on it as mortgage interest. And a third home would not qualify, but a first and a second do qualify for tax benefits. And so it can be some property at a resort area, or like you said, it could be a motor home. There's a number of things that actually qualify as second residences.
As long as it has a restroom.
Yes.
Okay. Well, I heard that, and I didn't know if that was true. That's why these people are buying them, I guess. Huh?
That's one of the benefits you can get.
What's the depreciation on those?
You don't depreciate a asset that's really a personal asset. It'd have to be used in business to be able to depreciate the asset.
Okay. Well, this is fascinating. Any last minute tips, because it's coming at us and people are procrastinating. What should people be doing?
My thought is plan year round. You don't want to just be planning when you're getting your tax stuff ready. Start your planning immediately and plan for 2014, even though you may be getting 2013 ready. Work at it on a continual basis. Thought that comes to my mind too is estate planning, and look at your wills, review your wills, make sure your wills and trusts are up to date and in order as well.
All right, Dan Kosmatka, and he has his own firm, Kosmatka, Donnelly Company here in Medford. They've been in business for a long time. If you don't have a good CPA, there's one right there, a good one.
Thank you.
And I guess you're taking new clients, aren't you?
I am.
Okay. All right, thanks, Dan, for coming in.
Thank you.
All right, we'll see you next time on Focus Today.